Okay, okay. I want to ask my next question here.
You have to people too.
Does economic prosperity depend on capital invested per worker? In other words, more capital invested per worker tends to produce greater productivity and therefore greater wealth.
The optimal capital-labor ratio of a plant depends on the rigidity and the cost of the workforce and the rigidity and the availability of capital. There are real problems with that in our society. Labor tends, especially in unionized industries, tends to be too rigid, and so we get higher capital ratios than we'd otherwise have. Productivity is the measure we have of how productive the capital aspect is, but in principle, tomorrow morning, do you want to close down a machine and hire 10 more workers? You want to lay off 10 workers and hire one more machine? That's a decision that's made. Most, in practice, almost all industries that mature and survive move from high labor per capita to low labor per capita.
Right.
In other words, productivity improves.
Let me ask you this question. So if you looked at, say, the United States and you compare it to India or China, you would see that there's a lot more capital invested per worker here in America than in these other third world countries.
Yes, that's true.
And that would be a significant, important factor that would explain why we have a more prosperous society.
Yes, it would also, well, it would explain also why it is possible for us to compete with India. Because India, having essentially a low productivity, has to invest large quantities of labor, and in countries that are growing, which India is now, or was anyway, that means that the labor will have a higher and higher cost, and so they have to continuously improve their productivity too. We do too, of course.
It's very simple, right? A farmer with a tractor can plant a lot more seed than a farmer in India with a manual hoe.
That's exactly right. And it's
like 1,000 times more.
It's more than that. It's yeah, that's right. It's also an interesting little statistic if you have a little time. The safety question always comes up in this. How many accidents per 1,000 man hours or man years, okay? That's really not the right way to look at it. We're not producing employment. That's not the purpose of a society is not to create jobs, is to create wealth, right? So what you really want to do is accidents per 1,000 units of output, or $1 million of product, of value added, and so on. In that way,
compare apples with apples.
And it turns out the Bureau of Labor Statistics calculates it on man hours consumed in that industry, which means that we underestimate the safety-enhancing value of capitalism. Almost every industry in America is becoming safer, and that's recorded. It's becoming even faster when you do it on the rational basis of output level, outproduce. Yeah, that's
very interesting point. Going back to the Federal Reserve, they're intent on controlling interest rates and keeping them low. This fits in with your description of how when the government tries to interfere with the economy, it has all sorts of negative effects. Isn't this a really bad idea, the Federal Reserve trying to control interest rates? And can you mention what are the major negative consequences?
Christine, where are you going to go next?
Well, the exhibit hall is at 4, so I'm going to go down there, and then maybe like there's several other parties that start.
How many interviews did you get me?
This is the last.
Okay, sorry. Wait a second.
The last question here.
Okay.
I was saying the Federal Reserve is intent on controlling interest rates low. They think that's a good thing. They don't want people to save. They want them to spend. Keynesian economics. And I was wondering if you would care to elaborate how many negative consequences there are when the government, in this case the Federal Reserve, tries to interfere with the interest rate and keeps it low. We were discussing before that if the interest rates are very low, then there's going to be less savings and the consequences of that. Anything else you want to add?
Yeah, I want to add a little bit more to that. If you think about the price of money, the interest rate, as being a critical factor in ensuring that the scarce capital is always scarce, gets to the most useful part of the economy. Maybe it's a bridge, maybe it's an innovation placard, maybe it's a classroom somewhere, maybe it's the very large number of areas where capital can be invested for our future. With the zero interest rates, it's very difficult for anyone to decide. everybody could use money at no cost. So you end up making it harder for money to flow to where it would be most useful for society. And that is one of the great challenges of a zero-rate world. It'd be nice if money were really that plentiful, but of course it's not. And so as a result, no one in industry, I think it causes industry to be worried. Gee, this looks like an awful attractive plant expansion. Well, of course it does at zero rate. What is it really going to be at a real rate of interest? So companies get to be nervous about investing, even though in the accounting sense, it might make sense. It creates a massive distortion in the planning horizons of companies, in their rationale and their confidence in their own rationale in deciding on investment decision. God knows how many billions, hundreds of billions maybe, of misinvestments have happened in America. Renewable energy certainly is probably almost certainly one of them. Infrastructure investments, all of the kind of things that become the politically correct cause of the day, they look free at a zero interest rate. And whether they're good or bad, almost certainly they've been overinvested in compared to other alternative investments, and then in part, a lot of other things, but largely because of the zero interest rate, and that's the Federal Reserve, and they're bad and they should be stopped doing that.
Thank you very much for the interview, Mr. Smith.